Hello and welcome to your Monday Futures Market Outlook for August 2nd, 2010. This is Patrick Ceresna. EminiSource.com is excited to announce the launch of its new trading room, trading the S&P and NASDAQ futures on an intraday basis every morning. Anybody that would like to try a 5-day complimentary membership to the trading room can register at EminiSource.com. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. Many months ago, we crossed bullishly above the 80-week moving average, asking the question as to whether or not there's going to be a sustained multi-year bull market off these levels. At this moment, we remain with our bearish bias from January 2008 that we're in a secular bear market, but we are going to be willing to adjust our thesis as we see how this entire sell-off in the summer actually plays out. There's 2 scenarios that we're looking at. The first and more bullish scenario is we have further weakness, obviously, into the August, September, October period, putting some sort of lows somewhere in the 950 to 1,000 level on the S&P, and then subsequently the market finds a good base and begins a year-end rally into January, February of next year. And this is a scenario we think has a good outcome, and if it does, we will change our stance to a much more bullish one. In the same regards, the reason why we still have not changed our thesis is that we cannot technically rule out that this hasn't been just one big rising wedge in what so many people label as a double dip recession or a retest of the previous lows. At this point, if we suddenly get some significant technical weakness into the fall, we could see a return to some aggressive selling, and we do not favor the scenario, but at this juncture we cannot technically rule it out. When we look at the daily chart of the S&P 500 futures using the E-mini futures contract, we see here that we had this little pop higher this morning, and we're continuing to see some rallying here on the upside. We still believe the upside targets lie in this 1120 to 1150 area. There's this nice target area around the 1126, 1129 area, and there's another really good target area up in the 1148 to 51 zone. Those are upside targets that theoretically can be achieved in the upcoming week or two on the upside, but we still do not believe that this rally will actually sustain itself beyond a short-term push higher over a week or two. As soon as we think this rally tapers out into one big rising wedge, we're going to be expecting selling to resume sometime in mid to late August, going into the September-October period, and we do believe that the previous lows will more than likely be retested, and maybe even as low as the 960 to 1,000 area on the downside. So at this stage, we're only short-term bullish, looking for maybe another 10, 20, 30 S&P points on the upside, and then we'll be looking for selling to resume at some stage. Just to quickly review our key points, our thesis since January 2008 continues to be that we're in a secular bear market, and only after this entire summer-fall consolidation will we consider rechanging that to a bullish one. The 1080 to 1090 support level held last week, and we're now looking for targets as high as 1130, 1150 on the upside. We continue to be skeptical about the sustainability of the rally into the fall, and it's important to stay conservative in your investment portfolios. Next here, I want to take a look at a daily chart of the E-mini NASDAQ 100, and what we're seeing here is, again, another little flagging formation that's breaking higher. We are looking for the NASDAQ to make a retest of its highs that it put in around that 1930 to 1950 area on the upside. We could even see a very temporary push even higher up to the 1970, 1980 area, but we are expecting the rally, once it finishes with a little bit of further momentum, to taper out somewhere up in these upper target zones. Next year, I want to take a look at the U.S. dollar index futures, and we had a continuation to the downside today below that 82, 82.50 area. Clearly, the euro strength and the dollar weakness continue to play a strong role in this. We more than likely at this stage may see a test as low as the 80 to 80.50 area on the downside here, which would equate to about the 132 level on the euro. So we're going to be watching where this move can consolidate down to in this stage. At some point, we're going to be expecting some sort of a legitimate snapback in the U.S. dollar, and when that snapback occurs, probably will drive an equity consolidation. So we're going to be carefully watching this, how it plays out for a further read as to when the market will reverse. Next year, I want to take a look at gold futures contract. We adjusted that focal point on the downside from the 1170 down to 1160, 1170 area, where the lows sort of came in last week. And at this stage, again, another little short-term low. This is the first time we've completed a solid test into our retracement zone. We felt that the retracement lower in gold could go even as low as 1130 on the downside, but we're looking for this 1130, 1140, 1150, 1160, 1170 area, that kind of a boxed zone in that blue area, to find some very important support levels for gold. If we see all of the intermediate lows kind of bang out in this box on the downside, then we'll expect gold to reverse and start to rally again at some point. It would take a legitimate technical breakdown below this blue box for us to become more bearish on it, assuming a much longer, bigger, deeper consolidation in gold. So we're going to get some critical information off these levels. Next year, I want to take a look at the E-mini crude oil contract. This morning, we had a technical breakout above the 78 to 80 focal point that consolidated all of it. It's a nice, good bullish breakout, but we did expect a measured move that could have gone even as high as the 82 level. So we are going to be very carefully watching whether or not this is a sustained breakout or whether this is a very temporary breakout higher that reverses back down. A lot of it will play on how the euro and how the U.S. dollar play out. If we see the U.S. dollar start accelerating to the downside, we could theoretically see crude oil come and retest the congestion zone higher, but we're not looking for that right now. Next year, I want to take a look at the 10-year Treasury notes. After a nice little flagging formation, a reversal break higher, there continues to be strength showing here in the 10-year Treasury notes. It's starting to look like a diagonal wedge higher. It's losing momentum while it's making the higher highs. We were looking for the 10-year Treasury notes to make their high somewhere in the 123.5 to 126 area. So we are starting to come up to completed upside targets. There could be a couple more pushes higher still here, but we are already quite satisfied with where the upside targets were. But we're not necessarily looking for a major reversal, but we are going to be watching for topping formations. That was your Monday Futures Market Outlook. Thank you for joining me.